Afternoon, everyone. Welcome to Nedbank's quarterly house view call, where we'll be sharing our macro and equity outlook for the first quarter of 2024. As usual, we'll start with the macro views, followed by the equity view per sector, and wrap up with the Q&A session at the end of the presentations. Please put your questions on the chat during the presentation, and we'll attend to them during the Q&A. Alternatively, we can unmute you during the Q&A session, where you can have a chance to ask your question. With that, I hand over to my colleague, Reese. Madam, please take it away.
Good afternoon, all. Thanks, Loyanda. From a growth and inflation perspective, since our last update, our growth forecasts have been revised marginally higher. We had a much more resilient first half of the year relative to what we were expecting, but still our forecast for growth for this year is at 0.6%, but rising to about 1.2% in 2024. For the 2024 outlook, what we are seeing is a combination of base effects affecting the macro forecast, the low base effect we think from this year for growth, and the high base effect from inflation, likely to provide some easing of constraints to consumers. From a growth perspective, there are key risks to the growth outlook. One of the major risks for South Africa, being a small, open, emerging market country, is the economic prospects of our major trading partner countries, China being key. While we are expecting Chinese growth to tick up marginally in 2024 from the current 4.5% real growth projected for this year, it is still much slower than the above 6% real growth rate that China has become accustomed to pre-COVID. Based on that, and based on the expectations for the US economy to slow down into 2024, there are serious downside risks to our growth forecast for next year. That being said, from a local structural perspective, we seem to be starting to put out one fire from an electricity crisis perspective. What we are expecting is for in 2024 to fall to an effective stage 3 load shedding from the current stage 4 or average stage 4 that we had experienced in the current year. From an inflation standpoint, we are forecasting inflation of 5.1% next year. That's an annual average. But we are expecting to see a deceleration in inflation, a more material deceleration in inflation come through in the second half of the year. And this is premised on the high base effect from food and fuel from this year. With this type of forecast in terms of higher growth as well as lower inflation, especially in the second half of the year, we do believe that sorry, can you hear me? Am I back on? Okay, sorry about that glitch. So it seems to be a network issue. In terms of the baseline forecast for inflation to ease into the second half of next year, we do think that this type of profile provides room for the CIB to ease or cut interest rates. The CIB has decided on holding policy rates for the last 3 meetings, and we do think that, given what the Fed does, we think that there is a high likelihood for the CIB to begin cutting interest rates around the middle of next year. We are projecting 4 cuts of 25 basis points each to the repo rate in 2024. Moving over to the next slide, with a very low real growth
All right, Walter.
Sorry about that. Can you hear me?
Yes, we can hear you, Reese.
Sorry about the network. From a macro perspective, while we are heading into a year with higher growth and lower inflation and possibly lower interest rates as well, there are serious fiscal risks on the horizon. The MTBPS that passed in November provided more questions rather than answers. There was no real resolution to the expenditure profile. And from a revenue perspective, we think the revenue estimates that were provided and updated in last month seems to be more realistic. There are downside risks to the revenue trajectory, but this is only likely in the 2026-2027 fiscal year. In the more immediate horizon from a fiscal perspective, we are seeing a deficit for the current year of 5.3%. This is a consolidated deficit, and a main budget deficit of 5.1%. This is about 40 basis points higher than what National Treasury has at the time of the MTBPS. We do have a marginally higher debt to GDP forecast profile, as well as a higher deficit profile. And if you move over to the next slide, we do think that from a fiscal standpoint, there will be a growing funding pressure over the next 2 years. In the 2024-2025 fiscal year, we do think that issuance need to increase across the board to be able to fund a bigger deficit. We are forecasting a main budget deficit next year of 371 billion. This is about 50 billion above what National Treasury is projecting, and we do think that National Treasury still continues the pace of very elevated weekly T-bill issuance, even though that they have mentioned that they would like to reduce the weekly pace of T-bill issuance. They would need to increase usage of cash. They would also, in combination of this, need to increase nominal and ILB issuance to 4.9 billion per week and 1.4 billion per week, respectively, to be able to fund a bigger deficit in 2024-2025. So even though we're heading into a macro horizon with low inflation, possibly lower interest rates, and possibly higher growth than what we experienced this year, there's significant event risks on the horizon and downside risks from a global perspective over our growth forecasts. So despite our baseline forecast showing a much more rosier picture for 2024, there are still some risks that we are still watching, which could negatively impact our forecasts. With that said, I'll hand over to my colleague Walter to take us through the asset allocation and fixed income view.
There we go. Thank you so much, Rees. So I'll just jump straight into this. So if you look at the table, and in terms of how we think about the different asset allocations from a macro perspective, currently, or maybe I should just start what we've been over the past 12 months, we've been consistently overweight the fixed income type stuff, and also neutral cash. And you can see that going into 2024, the last column in the table, we continue to think that fixed income nominal bonds specifically is for us one of the asset classes on a risk-weighted basis that's going to continue to overperform in terms of expected returns. One of the key changes that we've made is that we now think that equities do look better than it did before. We have been consistently underweight equities for the past 12 months, and we do have that now more on a neutral recommendation. And this really comes from two perspectives. The one is we think from a valuation perspective, equities now is better valued if you think about it from a PE perspective. And then secondly, we think slowly but surely the earnings cycle is also changing with respect to South Africa. And both of these are bringing up a higher expected return for equities. And that brings me to the next chart, and that is just on the bottom left-hand side, where you can see our expected return on a 12-month horizon. You can see that we think that equities is around about 12 to 13% on a 12-month view. And then the rest of the asset classes are very close together, around about 8 to 9%. Nominal bonds in terms of expected return, 9.5%, and it is less than equities on an absolute basis, but knowing that we're going into 2024, where, as Rees has pointed out, domestically, but also globally, there is quite a lot of risk events that could result in quite volatile markets. We do think that we should put extra weight on a risk-adjusted type return here. And once we work out a Sharpe type ratio, nominal bonds still stand out, which does say that we think that nominal bonds remains an overweight, and then equities up from an underweight to a neutral. The last point I'll make here is just before we move to the next slide is We look at our equities as an asset class, not individual equities, but as an asset class from a top-down approach, where our macro view that Rees has discussed becomes our bond view, and our bond view in a consistent, internally consistent manner then becomes our equities view, our cash view, as well as our listed property view. So it's a top-down, internally consistent view. If we move to the next slide, just a bit of color in terms of how we think about bonds. Specifically, we do think that you need to be increasingly careful kind of where you sit on the curve, specifically given the rally that we've seen in nominal bonds post the MTBPS. We do think at the front end, cash continues to compete quite well, given where bond yields sit now. And we do think that the ultra long bonds, given the fiscal risk, given the growth risk that South Africa sits with, is not necessarily providing enough value currently. So we do think you really want to sit slightly overweight a duration. You can see that we think the Orbi is going to return 9.5%. The sweet spot for us is around about 2035, maybe up to a 2040. So you want to, in our view, avoid the short end, and you want to avoid the ultra long end if you want to maximize in terms of fixed income nominal bond return. The last thing, and that's just to touch on the currency. If we go to the next slide. Currency, of course, remains always quite a difficult customer to look at. But if we think of where we are in the cycle, we do think, number one, given that monetary policy globally is starting to ease, that should favor EM currencies and duration/EM in general. That is also consistent with our macro and our asset allocation view. The second thing is that we think that where the rand is now is it is pricing in a lot of bad news already, especially the domestic news, which generally tend to be the case for South Africa. And we look at various indicators, and one of the indicators, of course, that we look at is that I've got on the left-hand side is the rand versus South Africa's commodities terms of trade. And there tends to be quite a strong relationship between these two, given that South Africa is a commodities currency. And we do think that this is, for example, low commodity prices, low growth, low EM type environment is already priced into the currency, and there is upside. The second thing is, if we just look at it purely from a where do we sit in the distribution approach, we do think that, and that's on the right-hand side, is that when we get close to a 1950-20 level, we do think that that's type of levels where traditionally the rand has priced in a lot of bad news. And at that type of levels, we do think we want to be a buyer of rand as opposed to a seller. Ultimately, we do think that 17 against the rand is a level that we would target. That, of course, will go hand in hand with weaker dollar, not necessarily only a stronger rand. And that is part of the global cycle as we shift, that's consistent with our macro view. I'll hand over to Ridwan, who will now take you through some of the property thoughts. Thank you.
Thanks, Walter. So just on the property sector, we are catching a bit in Q4, up 7% since October. Year to date, however, the sector is down 1.8%, and that's on the back of higher financing costs weighing on earnings growth. However, if you look at the 3-year swap rate, it's about 130 basis points off its peak, which makes the potential for hedging more attractive going forward. We do believe the company strategy should remain consistent with what we saw this year. This includes improved gearing levels and through earnings retention and disposals, and they'll look to minimize debt and hedge expiry risk. They'll look to roll out backup solutions in the face of load shedding and improve operational metrics through lower vacancy rates, improving tenant sales, and improving rental reversions. So just on the slide 12, on the bottom right, we show that the local portfolios have declined about 8% since FY19. The sector has seen a stabilization in SA property values, with 2023 seeing marginal growth of 0.7%. If we reference to 2019 to 100, we can see a clear divergence between urban centers and non-metro township assets, and we do expect valuations to remain stable in 2024. Just on the top right chart, the sector currently trades at a 40% discount to reported NAV, which is above its 3-year average of 33%. However, we do show that international property markets are currently trading at a larger differential to its 3-year average. Just the bottom left chart, The SA direct property total return has averaged about 14% per annum. Total return is highly correlated to SA real GDP. We incorporate our Nedbank's SA GDP forecast, and this is would estimate that direct property could generate 3-year CAGR of around 10%, still below long-term average of around 14%. If you go to the next slide. So here we just looked at about 600 asset disposals in SA across 16 companies, generating about 42 billion rand in sales over a 4-year period. In the top left chart, you can see retail assets accounted for about 38% of these disposals, followed by industrials and logistics. If you look at the top right chart, what is interesting there is that we have seen an increase in activity in office disposals this year. This can be attributed to the ATAC and Robosis transactions, which took place in the second half of this year. And you can see activity in the industrial and logistics sector being relatively consistent. Bottom left, we just show total disposals since FY19. Robosis, Growthpoint, and Redefine have been the most active. However, as a percent of the local portfolio, you can see on the right-hand side, Robosis, Spear, and SA Corporate leading the pack. If you go to the next chart, the next slide, please. On the left, you can see the average discount to the last reported book value achieved was around a negative 0.7%. That is impressive. Growthpoint and Emira have been outperforming on this basis. And on the right chart, however, we look at the average sale price relative to the 2019 book values, and that was down about 12%. You can see Resilient, the only company to sell above its 2019 values. However, that was only one asset. Away from that, Spear, Fairvest, and Redefine outperforming peers on this metric. So just to summarize, we think property companies have been responsible sellers in the current environment, have been price conscious despite, market and investors calling on them to reduce gearing at all costs. If you go to the next chart, next slide. So here you can see the sector trading at an average discount of 41% to reported NAV versus 40.5% in the previous quarter. The discount has narrowed if you included recent share moves. Average sector LTV of 36%, but you can see it's supported by international counters. Just a final slide for me, please. And then here we summarize our calls on the slide. We maintain our overweight recommendation in Redefine, Nepi, Rockcastle, and Resilient, and we upgraded Growthpoint and Emira to overweight in the last quarter. From a sector view, the sector currently trades on an earnings yield of 11.2% and a forward dividend yield of around 8.7%. We imply a PE ratio of 8.8 times using our fair value estimate for the SA long bond. This implies an earnings yield of around 11.3%, which would suggest that the sector is fairly valued at current levels, and we maintain our neutral recommendation. With that, I now hand over to Paul. Thank you.
Thank you, Ridwan, and hello, everyone. So I'll just talk about the retailers and the industrial sector. We currently advocate an overweight rating on the South African apparel retailers. We're neutral on the food retailers, and we're overweight the South African industrials that we cover. On the pharma retailers, Clicks and Dis-Chem, we do acknowledge there's some really good structural growth drivers that are still attractive. The pharmacy consolidation, robust new store rollout, but we think the current valuation already discounts that for Clicks and Dis-Chem, and hence we're neutral on them. So just on the apparel sector generally, and actually on the overall sector, if you look at the scattered chart at top left, you will see that there's clearly a correlation between earnings growth and valuation in the retail sector. Clicks, Dis-Chem, and Shoprite enjoy the highest valuation on a PE basis, and also on our forecasts should be showing the fastest 3-year earnings CAGR in the sector. We remain constructive on the apparel retail sector. We currently suggest an overweight rating, given prospects of better GDP growth that Rizwan has talked about, and also lower inflation and 100 basis points cut in cumulative interest rate cuts, which should commence from about May next year. Our preferred counters in apparel are Mr. Price, Truworths, and Woolworths, all overweight rated. We're forecasting like-for-like revenue growth of between 3 and 6% for the apparel retailers we cover over the next 3 years on average. On our forecast, Woolworths, Fashion, Beauty and Home will have the fastest like-for-like growth at around 5.6%, then Pepkor 4.7%, and then Truworths at around 4% per annum. As in the food retailers, what we are seeing is still fairly reasonable new store rollout, and rising capital intensity, which is having an impact on return on invested capital negatively, with the exception of Woolworths, which you can see from the top right chart. Margins have also been under pressure, with the exception of Woolies, Fashion, Beauty and Home. We do think for Mr Price that margins are at or close to trough, having post the reset over the last year or two. And our overweight rating on Mr Price is predicated on evidence of market share gains in the apparel division and prospects of gross margin improvement, as evidenced already in the second quarter. Now, the port congestion issues remain a risk for the sector, especially for apparel in terms of the imports. It's likely to add costs and complexity to supply chains, and Pepkor has the highest level of imports in the apparel peer group. Valuations in the apparel sector are still at large discounts to history, 10 to 30% PE discounts, while earnings are actually close to or at peak, with the exception of the Foschini Group. So Mr Price no longer trades at a premium valuation to the sector, yet the margins have reset. The returns are still very attractive, and the balance sheet is best in class. We're neutral on the Foschini Group, given weak growth in Australia and the UK, and we're still underweight Pepkor, given the 30% PE premium to the peer group, and the fact that there's still the overhang, given the Steinhoff creditors still own 44%. Next slide, please. For the food retailers, it's still a very highly competitive and promotional environment. Shoprite has gained share consistently, while Spar has lost some share. In fact, Shoprite has now gained market share in South Africa for 55 consecutive months, with Pick n Pay corporate stores having lost some share, Boxer, also part of Pick n Pay, having gained. Over the past 7 quarters, Shoprite was on average the cheapest food retailer in SA on our basket of around 190 products. You can see that from the top right chart. Promotional activity is still very, very evident in the sector, and everyone is promotional, but in the third quarter, Macro was the most promotional. That's come down. Food inflation did seem to be moderating, but it has picked up again in October to 8.8%, driven by vegetables, dairy, and fruit. We do see a further reduction in food inflation, but we think it's probably going to average around 6% for our food retailers over the next 12 months or so. We prefer Shoprite, which is overweight rated. Pick n Pay, we're underweight, given the risks to earnings and the stretched balance sheet, and we're neutral on Spar as well, given they have the worst balance sheet with 3 times net debt EBITDA, although they're not in breach in covenants. Lastly, next slide, please. In the industrials, we're overweight all 3 counters. Bidcorp is our preferred play, overweight there. Revenue growth rates are normalizing, which you can see from the middle chart, with organic growth coming down. It's still robust in the first 4 months at 12.8% and compares favorably to our full year forecast of around 10%. Bidcorp also trades at a discount to its historical average valuation, which we think is unwarranted, given the strong growth that we still see there in a fragmented food services market. Lastly, on Barloworld, we think the unbundling of Zeda and the sale of logistics makes this a cleaner company. Yes, there are risks from Russia, but we value that at 0 in our sum of the parts. And as you can see from the top right chart, the return on invested capital at Barloworld is now above WACC for the last 2 years, as they have cleaned up the portfolio and sold the auto and logistics businesses. I'll leave it there and hand over to Sean Chowkey, our resident Tiger Bull. Thank you.
Thank you for that, Folly. Much appreciated. Afternoon, everybody. I just want to spend a bit of time on soft commodities today. I think what's very important to note here is to understand sort of the company hedging policies. So where they run from about 4 to 6, sometimes even go as long as 9 months. So, year on year, year to date, you would have seen the decline in terms of maize and wheat, and I'll spend time on just wheat and maize because if you look at the main producers, that's about anywhere between 14 to about 25% in terms of the cost of sales. So on the maize outlook, I think there's been a little bit of a spike that you saw in November. I would say do not panic. Obviously, if you look at the economics in terms of the production outlook for maize this year, it's looking very good. So what's driving that? There's a little bit of El Nino concerns coming through, and I think it's becoming a little bit of an opportunistic moment for farmers to price maize prices a little bit higher and make a little bit more margin. But if you look at it from a production outlook, soil moisture, you know, when you have conversation with the farmers, is still good, but that risk is still there. But I think there is a bit of a tailwind coming through as the producers would have hedged at sort of lower prices, and you'll see that benefit come through. So that's just on the maize side of it. If you look at it, the wheat part of it, you would have seen global wheat prices ticking up again last year. After going down for a lot of, but down about 30-40% before last month. Again, on the global side, if you look at the outlook on production, very good in terms of that side of it. Interestingly, what you did see on the local wheat prices, you saw those prices coming down, and wheat is such a big part of it because it's a key ingredient in terms of sort of carbs and all that. So net, we think there's a little bit of tailwinds in terms of the input cost for the producers. You know, you speak about rice, that's a different story where prices have gone up. It's going to be a bit of a pain. And there's a little bit of a mix in terms of too many moving parts if you look at the basket in terms of costs. So, but on a net basis, we still think there is enough in the tank for a lot of these guys to see in terms of a recovery on earnings. So I'll just move on to the next slide. I think it's a very exciting time for the food producers. The sector has taken a knock. If you look at the past 5 years, it hasn't been very pleasant. It's probably been the unloved sector in the market where it saw the big declines. But I think what you are seeing, we're starting to see a recovery in earnings. One, mainly because of what I spoke to in terms of the soft commodity side of it, but two, particularly in the case of Tiger, where it's a very much about a turnaround story, where they've identified initiatives which will be very vital in terms of seeing a recovery in earnings. And then similarly, AVI, very good, strong cash business with strong brands. And even if you look at where they're trading, you compare that to peak margins, very much still running at peak margins, yet they're trading at almost about a 20% discount. With Rhodes, a very good story in SA, where you've seen them come gaining market share, and as a result, you've seen the business, improving its cash flow, reducing its debt, and more importantly, gaining a little bit of market share. Lifestyle, a little bit of on goals going on in terms of portfolio restructuring, etc. But I think it's the one where investors need to be a little bit patient in terms of that execution side of it. So, we continue to be very bullish across the sector. And then the last one I forgot to mention, obviously, it's Premier Foods, where I think they really understand the cooperation of running a milling and baking business. So we continue to think it's very positive for the food producers. You have seen the earnings come out last month and last week, where we're starting to get a little bit of hope and recovery in those earnings. With that, I will now hand over to Prashino.
Thanks, Tiger. So yeah, on the telecom sector, we are overweight the sector, but let's first talk about network uptime that has improved over the last year. Year on year, we have seen a lot of the networks invest heavily in power resilience, and that's resulted in improved service revenue growth over the last 4 quarters. You've seen that the network uptime advantage that Vodacom once had over the other 2 networks start to diminish, especially from MTN, who has pumped a lot of money into their network over the last, I would say, year, and they've earmarked about 2.5 billion to actually go into network resilience over an 18 to 24 month period. And you can see that in their numbers. Their service revenue growth kind of matched Vodacom in the last quarter. Beating them was obviously Telkom, but Telkom is a data-heavy network. About 89% of the devices on their network are 4G and 5G enabled. There's very little, there's about 2% that's actually 2G for pure voice, and also very little 3G devices, which is primarily used for voice. And during load shedding, what we find is the first hour, everyone goes online and they actually use more data as opposed to communicating with voice. So that's what's kind of driving the service revenue growth. And if you listen to what Rees had said earlier in the presentation that she expects reduced load shedding, that actually bodes well because data is quite sticky. Once you start consuming a lot of data, you continue to consume a lot of data, if not more. And that bodes well for FY24 and going forward. Moving on to the significant variations in exchange rates, and that's what's kind of driving what we see in MTN and Vodacom. And I've put a chart there for the parallel market rates for both the Naira and for the Egyptian pound. So the Naira obviously affecting MTN through its exposure of MTN Nigeria, and the Egyptian pound affecting Vodacom through its exposure through Vodafone Egypt. And you can see that currently we've got about a 40% differential between the official rate and what they call the parallel or the black market rate. Now that's, when we say parallel black market rate, that's kind of like what the rate that's quoted on some websites, on Bureau de Change websites, of what you use to actually get money outside of the country. Outside of the country to repatriate funds. Now, for the bigger companies like Vodacom and MTN, they can wait. They have the luxury of waiting for official windows to open. So they'll pay a slight premium to the official rate, but not as high as the parallel market rate to actually get that money out. From what we understand, the dividend from Egypt is actually still sitting in Egypt in an Egyptian bank account in Egyptian pounds. Naira does come out of Nigeria, but like I said, at a slight premium. And then the last one, the perennial bride, will she finally get married? That's the question around the SwiftNet sale. Now, we think it's closer than ever. Now that they've classified, the Telkom Group has classified the SwiftNet Mast and Towers business as held for sale, and they've identified a final bidder. We think that there should be in the short term an announcement of who exactly is the bidder and what they'll pay. We've done just a rough estimate, and subsequent to this report that went out, we also published an updated Telkom note where we've given the same valuation range, but we think that between a 6 to 8 times EV to EBITDA is what, it's what Telkom Group should get for their SwiftNet Mast and Towers business. Just a reminder that they do intend to sell the whole business, and they are concurrently also looking to sell parts of their BCX data center business and their OpenServe fiber business. I'll leave it there and now hand you over to Leander to take you through healthcare. Thanks.
Thank you, Prashino. Healthcare, we remain neutral on the sector with an overweight recommendation on 2 of the 4 listed names. On the hospital front, we remain neutral given the lack of growth catalysts in the sector and the rising evidence of structural decline. Private healthcare is still largely driven by employment numbers. Now, with GDP forecasted to grow 1.2% in 2024, we don't see any material job growth on the back of this, and therefore expect PMI membership to remain fairly stagnant. What is interesting to note, though, however, is that the PMI membership pool is now tracking above pre-COVID levels. However, what we are seeing in the private acute care space is that admissions are still 10% below pre-COVID levels. Looking across the sector, we are seeing higher admissions in day hospitals, subacute facilities, and we therefore conclude that there's increased competition in the market, and the complementary care segments are taking on volumes and therefore gaining market share from the listed players. The increased competition for admissions, the lower pricing as a result of bargaining power by healthcare providers, and the rising costs worsened by nursing shortages will result in lower margins and earnings growth over the short term. However, we are overweight Netcare and neutral life healthcare, and we are happy to share our individual company notes which give you more insights on the individual companies and why we rate them differently. Next slide, please. If we're looking at the pharmaceutical sectors, we are overweight Aspen. Aspen, in our view, is in a unique position of strength at the moment. It has a 3-year earnings CAGR of 10% and a target price of 196, which still gives you some decent upside. The reason why we are overweight Aspen is that the capex is actually forecasted to be lower since they are done with the sterile manufacturing build. The fixed costs are largely in the base, and the balance sheet is strong at a net debt to EBITDA ratio of 1.6 times. Now, the earnings CAGR of 10% can actually be higher as soon as they fill up that manufacturing capacity. They still have around about 3 lines in the Gqeberha facility, which is not filled at the moment. And they have around about 100 million dosage volumes that are remaining vacant or that is still not filled in the France facility, though there's still some upside in terms of filling up that capacity, which will have a material impact on earnings going forward. On Adcock Ingram, we remain neutral. It has a higher exposure to low SEP price increases, and it has a lack of growth catalyst, so they don't have any potential portfolio brands that are adding, which could boost earnings, especially on the OTC front. So overall, Adcock Ingram is fairly stagnant and they're just basically chucking along, and there's not a lot of growth catalyst in that. And I'll just leave it there and hand over to my colleague, Arnold.
Good afternoon, everyone. So on the PGM sector, obviously you've seen we had a significant pullback in the basket price that you can see on that chart there. That's obviously putting margins under pressure, and the industry is currently in quite a dire state, with probably 70% of the production base being unprofitable on a free cash flow level based on our numbers. But as you can also see in the chart, we do expect a material bounce from current levels. But that's not to be confused with a bullish view. We're not really bullish. We're just saying, look, the sector's oversold. The pricing we're seeing now is not driven by longer term fundamentals. It's driven by short term distortions that we do think will clear over the next 6 months or so. So what could see that clear? We need to see higher vehicle sales numbers. We have seen signs of that start to emerge. One of the big overhangs for the sector in the short and the long term has been electric vehicles. So there's been a big increase in electric vehicle sales over the last year or so. But again, there we are seeing a slowdown. So if you look over it, look out over a 6-month period, we think we're going to see better ICE numbers coming through and a normalization of this ICE to EV ratio. And again, that should be positive. And then as always, and Tabela will elaborate on that, we need China to start to come through strongly again in terms of their economic growth and construction activity. And again, that should be a positive catalyst for the sector. So where we are now, we probably see it as a low point. The question is how long can we stay at this low point and how big could the bounce be? That remains to be seen. The key catalyst there really is vehicle sales that needs to come through. In terms of the equities, if we turn to the right-hand side, obviously the basket price has pulled down the stocks with it. Valuation multiples sitting at almost all-time lows, 4 times forward on a 6 to 12 month basis. So that shows there could be some potential value, but it also tells us that the market is still pricing in a lot of risk. And it's not just metal price risk. There's a lot of operational risk as well. Load shedding, we are heading into election year, which could be disruptive to the production base. And the sector globally, the mining sector globally still faces significant inflationary pressure. So the multiples are low for a reason. It's because the outlook is quite challenging for this sector. But again, if we do see a bounce in the basket price, undoubtedly we will see the equities correct. So how do you play this? Our view is Impala is quite levered to upside in the basket price from here, and that's one position you can take. Sibanye is also levered, but they've got a lot of moving parts in their battery metal strategy. So from a risk reward perspective, we prefer Impala. If we have a protracted downturn, you want to go for the safe plays, and that is companies at the lower end of the cost curve with strong balance sheets, and we believe Amplats and Northam ticks the boxes on those fronts, on that front. Over to the next slide. Let's quickly talk about gold. So the gold price is driven by the real rates, and you can see the chart on the left-hand side. There's a big decoupling between the gold price and real rates. So given the recent rally in the gold price, again, we think there is some gold price downside risk. And we just caution on that. We think a lot of the gold price support that we've seen over the last year, and particularly over the last few months, has been on the back of rising geopolitical tension. So if we do see an improvement on that front, not likely in the short term, but again, if we do see that, gold could lose some of the safe haven support. If you look at the chart on the right hand side, that's our trading model. This is at the time of print, about a week or so ago. Since then, obviously, the gold price and the equities have had a significant run. And we believe at this stage, you probably want to start taking profits in the gold equities, and the stock like Harmony in particular. Once it gets above 100 Rand, you really want to start to take some money off the table. So we wouldn't be buyers of gold at this stage. We would use any spikes from here to exit that position. I think I'm going to leave it there and hand over to Tabella. Thank you.
Yeah, thanks, Anna, and good afternoon, everyone. Yeah, just quickly talking about diversified miners as well as underlying commodities. So looking into next year, 2024, we think there's likely a potential moderation in commodity prices, and this will be driven by a weaker global macro versus this year. I mean, in 2023, we've also had a weaker global macro versus 2022. So just the reduction in economic activity that will likely to continue to impact commodity prices negatively. However, though, we think although our commodity prices are likely to decline, but they are likely to be more or less supported by industrial production as well as manufacturing. So if you look at what has happened to industrial production, especially in 2023, has been decimated by quite a lot. This year it's expected to be around about 1.1% growth versus 3.1% last year. And therefore next year, on the back of some recovery, especially from coming out of Europe, as well as also some Southeast Asian countries, and then also just in terms of as the rate cutting cycle starts next year, and your manufactured good as well as constructions of buildings starts to come back on the back of cutting rates, that is likely to somewhat benefit commodity prices. So, however, though, year on year, we still think commodity prices are likely to decline, as shown by the chart on the bottom right-hand side. Briefly speaking about manufacturing, which is the bottom left-hand side chart, you can see that from COVID in about 2020, there was a big or strong recovery in manufactured good demand, and that resulted in manufacturing PMIs being quite strong for the most part in 2021. That was mainly driven by people wanting physical good or manufactured good. However, though, as countries moved from lockdowns into sort of opening up their economies, services became the key part of global market growth. And as a result of that, manufactured good sort of started to decline, or the demand for manufactured good started to decline. And I mean, I don't have the chart here, but if you look at services PMIs, those have been quite strong since about 2022. And we think potentially there's likely to be that switch from services to manufactured good. And like I said, on the back of, sort of rates declining, as well as also inflation declining. Moving on to the next slide. Just in terms of the implications of this for the South African diversified mining companies, we are overall neutral the sector, given, like I said, the moderations in prices and inflation, which seems to be still, to a certain extent, especially mining, I'm speaking now, but mining inflation, which seems to be still sticky and still troublesome for mining companies. And this will likely result in muted earnings as well as muted shareholder returns. However, though, we do have preference for diversified commodity exposure for companies such as South32 as well as African Rainbow Minerals. Particularly, we like South32, and the reason for that is the company has I think, an enviable commodity exposure, which is puts it in the part to in fact benefit from the energy transition, having been exposed to aluminium, copper, zinc, nickel. So as the global world demands those types of commodity for the energy transition, South32 is likely to be one of the winners in terms of mining companies. And then talking about Exxaro as well as Tungela, we do have a negative thermal coal outlook. I think if you look at our thermal coal prices moving into next year, we're quite negative, and this is driven by that we think post the winter in the northern hemisphere this year, that coal prices are likely to moderate lower, driven by a normalization in terms of the supply demand balances, as well as also you have China and India, which are your biggest consumers of seaborne thermal coal, which are increasing their domestic production, therefore will likely require less thermal coal going into the coming years. And then finally, Kumba, we have downgraded our Kumba recommendation from a neutral position to an underweight. That's mainly driven by the company has run hard in the last quarter, up about 40%. This was on the back of very strong iron ore prices. And, like I said, we're seeing prices moderating next year, and including the iron ore price. As the iron ore price moderate, therefore, Kumba as well is likely to more or less moderate. And we think, as much as iron ore has been strong this year, but some of the drivers for that strong iron ore are still we don't think they're likely to repeat next year, especially when you don't have a Chinese property sector pumping. I will leave it at that and give it back to our Q&A. So Luyanda, back to you.
Thank you, Tobela. I see a few questions on the chat have been answered. I'll just give this opportunity to everyone else on the call. If you have a question, please do raise your hand and we will unmute you. I see there's a question from Khanya.
Thank you again for organizing the call. I've just got a couple of questions to get through from each section. To start off with the economics part, is there a capacity in South Africa that's structurally not able to recover? One, from the internal side, so you have load shedding that's killed a lot of industry, especially in manufacturing. And secondly, on the exogenous side, so you have China growth, which is changing from that manufacturing or that investment towards more services. So that sort of growth doesn't benefit South Africa. So is there that structural component from both sides that's affecting us? Secondly, it's on the property. So I just wanted to expand on it. I mean, a lot of what's mentioned on today's call tends to benefit property, right? So you've got South African growth that's better next year. You have 4 rate cuts. Lower yields on the fixed income side, load shedding stabilizing, and you also have the retailers that are improving, and also the supply of floor space. So I mean, I can name 3 other factors, but it seems like the property sector has a lot of tailwinds, and yet the position is still neutral. Then lastly, it's on the equities side that, I mean, and it's a 2-pronged question. The first one is the one I put in the chat, that I mean, it seems like we're at the bottom, and if things are going to improve slightly next year, especially on the rate side, why would the position be neutral in equities? And secondly, are we at a structurally lower valuation? I mean, I think we're at a discount to EM peers at the moment, whereas at a point, I think 3-4 years ago, we were trading at the same level as developed markets. So are we now just at a point where structurally we're not able to recover on that valuation aspect? Yeah, that's it from my side.
Okay, quite a mouthful. I think on the China structural shifts, etc., especially when it relates to mining commodities, I'll hand that question to Tobela, and then Reds, you can touch maybe on property.
I was gonna say I think maybe Rizwana can take on the structural issues when it comes to SA, and then I'll elaborate on China commodity. Thanks.
Okay.
Thanks so much. So you're quite right. If you think of pre-COVID times, Chinese growth was, in some instances, double than what it is projected to be over the next 3 years. China consumes and consumed more than half of all of our mineral exports. So a big boost to South Africa growth pre-COVID. Going forward, I think over the next 3 years, South Africa's growth rate is structurally low, so around 1%, because of the combination of weaker Chinese growth, or I guess the multiplier or the boost from China growth that we would have gotten pre-COVID, which was mainly due to its manufacturing and industrial base, and that's shifting now, but also as a result of the lack of electricity in the past year and in the past 24 months. So pre-COVID, South Africa's potential growth rate was close to 2%, I think 1.9%. Post-COVID, that is very much close to 1% or 1.2% in some years. If we were to resolve load shedding completely, we do think that this would provide a bit of a structural boost to growth. But it does seem as though in South Africa, when you start to put out one fire, there seems to be another fire starting, and that's on the port and logistics side with regards to another failing SOE, which is Transnet. So we could see growth recover a little bit on the back of lower stages of load shedding, and then probably by 2026 an end to load shedding completely. But on the flip side, we have our biggest trading partner country with half of its growth relative to its golden years before COVID. On the back of that, still about 18 to 24 months to go before we see any resolution or improvement on the logistics side. So I think our sentiments remain the same relative to compared to what you've started off your question with. Potential growth in South Africa likely to remain low, and obviously this doesn't bode well when we look at the likes of India that's growing at above 5% real. So we do need a bit of a structural boost, a structural shift, maybe another commodities boom, another industrial boom globally to be able to boost and shift South Africa's growth rate to 2%. So for now, it remains in the low 1% region.
Yeah.
Thanks, Reason. And maybe I can just add on property. Okay, go together.
Yeah, I was gonna say, just to still sticking with the macro stuff. So just talking about China, China economy and the structuralness in terms of what's happening there in China. So I think prior to COVID, you had Chinese GDP growing at closer to 10%. And then I'd say around about COVID time, somewhere between around about 6 or so, 5 to 6%. And then I think focus going forward, it's slightly below 5%. So there's definitely a structuralness in terms of, that Chinese GDP, and that will definitely have an impact in terms of commodities. And of course, you have the Chinese real estate, which is the biggest consumer of all the commodities, which is in its own structural decline, given the overbuilt in terms of apartments and residentials in China. That needs to stabilize much lower. So, I mean, that used to grow, so I'd say between 2005 to 2015, over 25%. And then from 2015 to about 2019 or so, that was hovering above closer to 10% or so. And during COVID, you can average is roughly, closer to 5%. So you can see the stepping down in that. However, though, with that being said, we do have the energy transition, which will be energy, sorry, which will be commodity. Will require quite a lot of commodities, and also infrastructure that's currently being built, in particular in China. However, though, those are not as commodity intensive as the property sector, which is currently in decline. Therefore, in terms of commodity demand, you are likely to see a structural shift lower, but you have some offsetting when it comes to the energy transition. But then again, when it comes to energy transition, certain commodities are likely to benefit more than others, with your base metals, such as copper, aluminium, zinc, and others likely to benefit more than your, let's say, your bulk commodities for things such as iron ore. Thank you.
Yeah, and then just from my side on the property, so we use a top-down approach, taking into account our a forecast for the real rates and inflation of around 5%. That implies a PE ratio around 8.8 times. Now, I know in PE property we don't talk PE, we talk earnings yield. So if you say 1 divided by 8.8, that looks at around 11.3% earnings yield. Sector is currently trading at 11.2. So from that perspective, sector is fairly valued. We're talking about we're seeing lower interest rates, and that should benefit property. Yes, but that will be over time. Remember, property companies hedge about initially around 80 to 90%, but it has dropped a bit given the higher rates and companies reluctant to lock at these rates, and the benefit of lower rates will come through in earnings over a longer term period. Like if I look at my 3-year CAGR earnings growth for the next for the counters I cover, you're looking at around 3.8%, which takes into account higher interest rates that will come through, given that you have hedges that are expiring, and then you lock in the current rate, or if you do hedge it, you're locking in the higher rate, and that will impact earnings. So from an earnings perspective, also we yes, you do see lower rate, but you don't capture it immediately. And I'll leave it at that if that answers your question.
And then just one to wrap it up in terms of kind of how do we think about equities, the last part of the question. Look, firstly, I'll mention, if you look at absolute returns, and that was also one of my charts, and there's also more detail on this within the document. Absolute returns, we do think that equities will actually outperform over the next 12 months. But given that we remain quite a volatile environment, and also all the domestic issues within South Africa and elections and some of the questions around that, once we start risk weighting the expected returns that we've got, equities still doesn't come out on top, and we think that on a risk-weighted basis, our numbers just suggest that you still want to be overweight bonds. It is, of course, all a relative game, right? You can't be everything overweight and everything underweight. So we have to make that toss up. The second part that I'll just mention is how do we think about kind of the valuations from a PE perspective for equities in SA? As Ritz has mentioned, we think from a top-down perspective. South Africa does sit with high real rates, and South Africa's real rates, and this is well known, and we see all these charts all the time, that South Africa's real yields is high compared to EM peers, and probably the highest. Typically, Brazil is compared with us, and currently we're higher than Brazil in terms of real rates, or real yields rather. And real yields, effectively from a macro perspective, implies that people are willing to pay less for the same earnings, which effectively means that your PE ratio is going to be lower from a macro perspective. And that's what we're seeing, we think is happening in South Africa. And you have to ask your question, do you think real rates will be higher structurally in South Africa, or is this just a cyclical component? Now, generally speaking, we think if we take a 3-year view, we think that the fiscal issues that South Africa does sit with will probably result in slightly higher real rates on a more permanent basis. And I'm talking now a 3-year view here, which does suggest that from a PE perspective will probably remain lower than what we were in past years, simply because real risk is higher. I'll leave it at that.
Kanya, I would just like to add there, if you are struggling to buy any of the local equities, there is Tiger Brands, which is screaming very much good value in terms of the turnaround story, what's happening. So there's good value there. Do we get to sort of peak multiples? Probably not. To your point, there is a little bit of that structural decline in those margins, but I do think to make your selection easy, Tiger Brands does come out screaming on that overweight rating. Thanks.
Can't hold back the Tiger Bull. If there are any further questions, please do just drop us a mail or reach out. Thank you all for joining the call. And we'll also appreciate any feedback that you might have for us for the next coming calls. With that being said, enjoy the festive season. May you find time to rest and spend with your loved ones. Stay safe, and we look forward to seeing you all next year.